From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for August 22nd, 2025. Let's see what's shaking. The hottest team in baseball, your Milwaukee Brewers, are home this whole week. The San Francisco Giants are in at the start of the week, and then they're followed by the Arizona Diamondbacks. The Packers wrap up the season this Saturday afternoon with the Seattle Seahawks in Lambeau. And if you're a fan of Mexican food, and who isn't, you'll want to be at the Summerfest grounds for Mexican Fiesta. Okay, let's get started with a question. Why isn't the following event here in Milwaukee? It's the Beer Mile World Championship. Here's how it works. Runners must drink a beer and then run a quarter of a mile, and then do it again 3 more times. So if you're playing along at home, that's 4 beers, 4 laps, 1 mile. The beer must be at least 12 ounces and no less than 5% alcohol. The runners can choose cans or bottles, and if they hurl, they need to take another lap. Again, why isn't this happening in Milwaukee? This next one is just as freaky as the Beer Mile. In northern Colorado, rabbits are growing horns and tentacles on their faces. No, it's not a fashion statement. These Frankenstein rabbits apparently are suffering from a common virus that has no risk of transmission to humans. When they say there's nothing to worry about, that's the time I start worrying. And we have a headline of the week. Walmart recalls possibly radioactive shrimp. The upside is you can eat them in the dark. On the podcast today, we have Adam Baley, John Sandstrom, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Does anybody know if rabbits like shrimp? Interesting week overall for markets. Pretty quiet Monday, Tuesday, Wednesday, Thursday. Everybody appeared to be at Wrigley for the Brewers-Cubs series, but mostly a down week to start. And then on Friday, announcement, or rather a speech from Jay Powell, the Federal Reserve at Jackson Hole this week, seemed to give markets a little bit of hope that maybe a rate cut's on the horizon, and allowed a pretty sharp rally on Friday to end the week. Dow up 846 points on Friday to finish positive, up 686 for the week. That's 1.5%. The S&P 500 up 0.3% on the week. And the NASDAQ NASDAQ down 0.6%. For the year, NASDAQ still up 11.8, the S&P up 10.7, and the Dow Jones Industrial Average up 8.2%. Well, Adam, we seem to be out of earnings season now. Most of the traders, at least for now, seemed to still be at the beach early in the week, and then we got an announcement from Jay Powell that potentially opened the door to a Fed rate cut here in September, and all of a sudden traders seem to be piling back into risk, piling back into stocks. Any big takeaways for you this week as you kind of look at what we saw, and most importantly, maybe what we heard from Jay Powell and the Fed?
Yeah, a few takeaways. One, it was a very quiet week leading up to Friday. I think everybody and their brother was just waiting to hear Jay Powell speak. And it was potentially his last speech at Jackson Hole. And I watched a little bit of it. He did get a standing ovation from his colleagues as he kind of parted ways. But his message was one of a bit of worry on the horizon. I mean, he did open the door for a rate decrease here in September, maybe later on in the year and into 2026. But he cited that the risks of worse than expected labor market outcomes are rising. He also suggested that the so-called neutral rate of interest rates that we've had in the past is likely going to be higher than it has in the past, which means that when they do get to lowering rates, it might not be as much as we have thought or in the past, or maybe as low as we might think they might go. On top of that, he did mention tariffs a few times, and he said that the effects of tariffs are having on consumer prices are now clearly visible and expected to accumulate in the months ahead. So again, I don't know if we're going to get a rapid decrease in rates, but at the very least, he opened the door for the potential of a rate decrease here in the near future.
And obviously, markets driven by earnings and interest rates, stocks specifically driven by earnings and interest rates, and so lower rates tend to be a sign that maybe you're willing to pay a little more for stocks. Of course, the concern is, why are rates moving lower? And so we get into these trends, I think, of bad news being good news short term for stocks. Bad news, hey, maybe the labor market's not as strong as we think, But good news, it means rates can move a little lower and potentially juice returns near term. And again, I think, John, maybe long term, I'd rather have good data driving Fed decision making than being forced to react to potentially some bad news. And in particular, the labor market, the thing that the Fed seems to now be more interested in than they have in a while.
Yeah, and it's funny that we talk about the good news being bad news being good news, especially in this situation where a few weeks ago when we first got the jobs data that started to show weakness, it was bad news. And today, Powell talks about the weakness in the jobs data, and it turns out to be good news for the markets because it's hinting at, those rate cuts. But I much rather be in this camp where we starting to see this, potential in bringing the rates back down closer to neutral. We knew that this was going to happen for a really long time, and it's kind of been market anticipation, and he's finally hinted at that cycle starting.
Yeah, I want to be clear with our listeners that in our world, bad news generally is bad news. And I don't want to be irrationally exuberant on some of the weakness that we're seeing in the labor market, but in our world, usually bad news is bad news. And also give everybody a history lesson on past rate decreases. This is not out of the normal. Actually, this is quite usual to see where the market rallies on that first one or two rate decreases, where the market's perception is, oh, okay, fine, the Federal Reserve is doing something to help out. It's usually not until rate decrease number 3 or 4 where the market steps back and goes, whoa, this isn't working. Maybe it is worse than we think. Not saying that's the path. I'm just saying over history, that is usually the path that we have seen when we begin rate decreases. Just a little historical perspective for what it's worth.
Yeah, a fine line between this time is different. And yeah, okay, maybe that history does tell us a little bit about what to expect going forward. I think the interesting thing for me was Powell's words on the labor market more broadly. The specific language he used was that it was a curious kind of balance, that the weakness that we are seeing right now on the hiring side has largely been offset by maybe fewer workers in the workforce. And pace becomes really important to the labor market. If you start to see those workers leaving slower now than maybe employers are cutting back, well, all of a sudden unemployment becomes a bigger problem. And I think that's very much what Powell is trying to get ahead of. What the Fed is trying to get ahead of is, hey, let's take our foot off the brake now a little bit. Yeah, we're not stepping on the gas yet and moving lower than that neutral rate, Adam, that you were talking about earlier, but we are now starting to say, hey, we don't need to be as restrictive because the pain of inflation is nothing compared to the pain of higher unemployment and a jobs market that maybe shows weakness. John, the article in the Wall Street Journal on Roth conversions, and I'm sure a number of listeners have seen it already. If they haven't, I urge them to go check it out. But it points out something that we've talked about here internally for a very long time, which is that it isn't just a one-size-fits-all approach to take a traditional IRA, all that pre-tax money, and just say, well, yeah, maybe we should make that a Roth IRA and pay the tax today. It is certainly a really big selling point, though, I think, for a lot of advisors that are looking for an inroad with investors to say, hey, if you're not having this conversation with your advisor, maybe you should because we think this makes sense. And then the extension of the current tax brackets maybe changed the thinking a little bit on those investors that were looking ahead to Roth conversions. What do we know now? And more importantly, how do you talk to clients about kind of the role that Roth conversion might play in their portfolio?
Yeah, and you and I were actually just talking about this earlier. I had a client ask me this exact question. A majority of their retirement savings is in pre-tax accounts, and they had been reading and hearing from other people, why haven't you converted to Roth? Well, it makes sense in a lot of situations for certain people, but it is a situation-by-situation basis, and I want people to be careful because there's a lot of information, articles, videos out there that are kind of saying, why aren't you doing this? And it's definitely a conversation that you need to be having with us because, like Kyle said, there's tons of different factors where it could make sense, where it doesn't make sense. Paying all the tax up front, when you're in your 40s, 50s, your prime earning years, you're going to be, probably making more money or having a higher income during those years than you will be in retirement. It doesn't make sense necessarily to pay all that tax up front just to, try to save money later.
Roth conversions can be a really great planning opportunity for people. And as much as we talk about investment diversifications, we need to talk about tax diversification, having different types of taxable assets and having more in the tax-free nature of the Roth. And if you're past the point of being able to contribute because either you make too much income or you're no longer working, you can't contribute, the only other way that you can get money into that tax-free asset is via conversions. And the way I see this and the way this is played out for many of my clients is there's a window where it can make a lot of sense for you, but it has to be done on a case-by-case basis. And say, for example, you retire at 65, but you don't need to take distributions until 73. You have this brief window where, okay, you don't have any working income. Maybe you have just a modest amount of Social Security income. You could get a fair amount out of the IRA, converted into the Roth at a lower tax bracket, and use up as much of, say, the lower 12% bracket if possible, if that's the case for you. That's the real window, say, when you retire to 73, to give some serious consideration for Roth conversions. Does it make sense in your financial game plan?
And, I think the challenge was that a lot of people used the potential expiration of the tax cuts as a tool to generate some fear in investors, right? That if you don't do this, your tax rates will go up. And I think the reality was that there is an expectation that maybe given our debt situation in our country, tax rates will go up. But the question is, will they go up for you? And that's where kind of that individual conversation has to happen. I think you add in that for many investors, the IRA, while they will have to start taking it at 73 in some amount, it's probably not money they're going to spend down in their lifetimes. And so it isn't just a conversation on your tax situation. Now it becomes a conversation on what do you want to happen with this money when you're no longer here? And if it is, leave it to my kids, my grandkids, well, potentially they're in a better tax picture than you are. And so in that regard, maybe a conversion doesn't make sense for them. I would add the last piece, which is one that our clients use quite regularly, and that is that IRAs are one of the best ways we know of to give money to charity once you're 70 and a half. And so if you are charitably minded, A, you could name charities as beneficiaries. They're not going to pay tax when you pass and leave that money to them. But B, you could use those required distributions as giving opportunities. And not only will you pay less tax, like you would maybe if the Roth conversion made sense and you were in a lower tax bracket later, but actually you'll pay no tax by giving that money to charities. The charities don't pay tax. And so if that is a way that you are otherwise wired, save some space in that IRA, not for Roth conversion, but potentially just keep letting it grow tax deferred and give it away over time. And so I think that's a really important kind of caveat to the conversation is you really do have to treat this as what makes sense for the individual. We got a small amount of economic data in a quiet week. Adam, the big one that we pay quite a bit of attention to is this survey of leading economic indicators. Obviously, we are always trying to digest where is the wind blowing, what direction are things headed. Continued signs of slowing, of weakness, but not quite recessionary, at least in terms of what the Conference Board sees in their indicators. I think one of the challenges potentially is that one of the big things supporting the survey of leading economic indicators is stock prices. Yeah. That stock prices are a leading indicator for the economy broadly. And you have had a bit of exuberance, rational or irrational. That doesn't matter for purposes of measuring. But you've had a bit of exuberance in stock markets that I think has made it a little bit rosier than it otherwise would have. But, some signs in that survey of leading indicators that maybe some weakness or some slower growth is on the horizon.
And we saw that in a couple places in the leading economic indicators that came out this week. They were down about 0.1%, so in the negative, showing a little bit of contraction in leading economic indicators. What came across in that report was some consumer pessimism, which was clear. And also, weak factory orders really did lead some of that decline down. And you can tie that in with what was a pickup in unemployment claims that also came out this week. So, tying a few pieces together, definitely not recessionary territory, but showing that the pace is slowing and some of the cracks are forming.
And I think as cloudy as ever when we look at the outlook, a lot of this is going to be dependent upon how we navigate the tariff conversation. A lot is going to depend upon how the labor market evolves, and especially responses to anything the Federal Reserve might do with respect to interest rates. If they are far enough ahead in cutting rates, and if the market, the economy broadly can see a little bit of a boost in productivity and in just economic output overall from those cuts, then potentially things are a little bit even better than what the conference board says. But I think certainly as you look at what's out there, some reasons to continue to be cautious. And then we got housing data. Obviously, a big part of our economy, 70% being consumer spending. Yeah, if you're going to buy a new house, you're probably going to do some spending. And so helpful, at least in July, Adam, that maybe existing home sales picking up a little bit. We're seeing a little bit more turnover, even if big picture things are still quite slow there.
Yeah, I suppose if there was a bright spot this week, you could say it was existing home sales up 0.8% from July. I like seeing that at a time when, gosh, you're hearing a lot of noise from the real estate market and real estate agents, and just it's difficult to find buyers and sellers and match people up and at realistic prices that people are able to afford. There's lots of kind of going on in the real estate market right now. So existing home sales up 0.8% in July. I like that number. It is a bit juxtaposed against building permits, which were down almost 3%. So, okay, fine, we sold some more houses last month, but we're not starting some new ones as quick as we would like. So more on that to come.
Yeah, and permit issuance at a 5-year low. So, certainly reflective of higher interest rates, reflective of, I think, builders' expectations of an economy that's a little bit softer. And so plenty to keep our eyes on, even as kind of the general theme seems to be weaker but still strong enough for growth. And with that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.